A stock is a share of the ownership of a company. As the owner of a stock, the stockholder, you have a claim on the company's assets and earnings. Suppose Steve is starting a company, Pies R Us. He needs $100,000 but doesn't want to borrow from a bank. Instead, Steve invests $10,000 of his own money and finds 9 other investors who are willing to invest $10,000 each. In return, he gives each investor a certificate that represents 10% of his company. Each certificate represents 10% of the company's assets, the building, the pie pans, and the baking materials, and 10% of any future earnings. After 1 year, the company is doing well, and the company's total value increases to $200,000. This means each share of the company is now worth $20,000. $200,000 divided by 10 shares. That's twice the original $10,000. The original investors can sell their stock in the company to other investors for a 100% profit. This is how stocks work. Stocks are bought and sold daily on the major exchanges. Bond investing is the purchase of the bonds or debt of a company or government. Vic wants a long-term investment that is secure and will grow, so she purchases a treasury bond. These bonds are promises from the government that they will pay you back your investment with interest. Treasury bonds can be purchased through a bank, a stockbroker, or online from the Treasury Department. The government uses the money from Vic's bonds to fund projects such as highway maintenance, public works, and even war. There are many types of bonds for a variety of different institutions. State and local governments issue municipal bonds to finance local projects. Companies issue corporate bonds to borrow money from investors instead of securing a loan from a bank. The companies can then use the money from selling bonds to build new factories, buy new businesses, or simply pay off older debts. Bond investing is normally considered a conservative style of investment. The return on investment is historically lower than you might get from a stock investment, but bonds are not tied to the stock market. Instead, they reflect the credit rating of the government or business. The riskier a business is, the more interest it has to pay to attract investors. So, if Vic wants to continue investing in debt, she can buy a range of bonds that have different interest rates and risk profiles. With some careful thought, Vic can create a bond portfolio that is as diversified as any stock portfolio. If diversification is Vic's main goal, however, she would do well to use a mix of stocks and bonds. As you look to build your portfolio, you will find that you have a large number of investment options. The two biggest components of most portfolios are stocks and bonds. So how should you use them? One decision to make concerns your goals for your portfolio. Do you want your portfolio to provide a steady income stream, or are you looking for long-term growth? Stocks generally produce the best growth over time. A careful selection of stocks, including both large and small companies from a diverse group of industries, can produce excellent growth over time. For income, bonds are probably the better choice. Bonds pay interest twice a year, and the amount usually never changes over the life of the bond. Investors can buy bonds issued by local or national governments, as well as by major corporations. Even if you're sure of your goals, there's always room for both stocks and bonds in every portfolio. For more aggressive investors who want growth, bonds can help balance the risk of stocks and stabilize the ups and downs of the market. For more risk-averse investors who choose an income-oriented portfolio of bonds, stocks can provide valuable inflation protection. The amount of interest that a bond pays is usually fixed, so an increase in inflation can reduce the value of those payments. Stocks will help you protect your money from inflation because stock values often rise faster than inflation. Your stock purchases provide an opportunity for high reward and help to hedge against inflation, while bonds will provide a dependable safety net against stock market losses. A mixture of stocks and bonds can help investors to maximize profits and minimize risks. Most investors are familiar with common stock, but many know little about another form of company ownership, preferred stock. What are the differences? The biggest distinction is that preferred stocks offer investors an added layer of protection. If the company becomes financially insolvent, preferred stockholders have a claim on assets before common shareholders do. Preferred shares also offer greater income security when the company is on relatively stable footing. Unlike common shares, preferred stocks pay set dividends at regular intervals. If the company can't make a payment during a particular period, it must pay the preferred dividend in arrears before any dividends are given to common shareholders. As with any investment vehicle, preferred shares have their drawbacks and their advantages. One downside is that they're not voting shares, which gives holders virtually no control over the company's management. Perhaps more importantly, their predictable payouts mean they trade at a stable price, leaving little chance of netting a large capital gain. In some ways, preferreds are more like bonds than common shares. In fact, they're rated for financial strength just like bonds, even if they don't offer quite the same level of investment protection.
Preferred shares have qualities of both stocks and bonds, which makes their valuation different than that for a common share. Preferred shares offer a fixed dividend payment that come at guaranteed intervals, be it quarterly, monthly, yearly, or some other period. To find the value of the preferred stock, each future dividend payment needs to be discounted back to the present and then added together. If ABC Corporation pays a 25-cent monthly dividend and the required rate of return is 6%, then the expected value of the preferred stock using the dividend discount approach would be $50. That's 25 cents divided by the monthly discount rate, or 6% divided by 12 months. Since every dividend is the same, the formula can be reduced to V equals D divided by R. V is the value, D is the dividend, and R is the required rate of return. Other considerations include the chance that dividends from preferred stock will be cut if earnings are too low to accommodate a distribution. The risk increases as the payout ratio, or the dividend payout compared to earnings, grows higher. Preferred shares have an implied value similar to bonds, and their value will move inversely with interest rates. If the preferred shares are callable, the buyer should pay less because of the added benefit the company enjoys. Dividend growth must also be accounted for. The calculation is D divided by R minus G, or the value equals the dividend divided by the required rate of return minus the growth number. By subtracting the growth number, cash flows are discounted by a lower number, resulting in a higher value.